Welcome to this explainer. Look, Bitcoin is on the move again, and today we're going to dive straight into the data to investigate its sudden recovery to the $65,000 area. We want to figure out what is really driving this market right now. We're going to look past all the hype and the headlines to see exactly what the underlying numbers are telling us. Let's kick things off with a massive piece of evidence. A staggering $853.54 million. That is the amount of net inflows that hit U.S. spot Bitcoin ETFs in just one single week, ending August 7, 2026. I mean, this isn't just some minor blip on the radar. This is a serious influx of capital that demands our attention, and it tells us for sure that institutional interest has absolutely not disappeared. So that massive influx of capital, it brings us right to the central mystery of our investigation today. It forces us to ask, is this a true market shift indicating a brand new bull run, or is it just another temporary spike? It's a really critical distinction because, as you probably know, this market is famous for moving incredibly fast in both directions. Is the bull market back? To answer that, we've got to look past the daily price charts and start gathering some macroeconomic clues. Sure, that recent jump back up to the $65,000 range is undeniably exciting for investors, but we have to remember the broader context here. We just came out of a brutally difficult stretch earlier in 2026, which was plagued by geopolitical tensions and major inflation concerns. One good week of recovery does not automatically equal a confirmed bull run. We really need to see if the foundation is actually solid this time around. Section 2, the rise of institutional money. What's really fascinating about this current market cycle is the structural shift in who is actually doing the buying. We're witnessing a complete night and day transformation. Think about the old way. You had to manage private keys, navigate complex crypto exchanges, and deal with the whole self-custody headache. Now, look at the new way with spot ETFs. These are regulated, exchange-traded products that easily integrate right into the portfolios of pensions and major asset managers. Traditional institutions no longer have to handle custody themselves, and that completely changes the demand channel. And we are absolutely seeing the results of that new pipeline. By late July 2026, U.S. spot Bitcoin ETFs strung together a 7-session inflow streak totaling roughly $981 million. So this renewed influx shows that institutions might be stepping back in. But here's the billion-dollar question. Are they making long-term allocations to hold, or are they just trading a short-term bounce? Section 3. Interest rates and liquidity. To figure out if that institutional demand will actually stick around, we have to talk about the global price of money, which brings us straight to the Federal Reserve. It's basically a fascinating 3-step chain reaction. Step 1, the Fed pivots towards easier monetary policy and cuts interest rates. Step 2, global financial liquidity conditions become way more supportive. And that leads directly to Step 3, where investors suddenly get a lot more comfortable throwing capital at riskier assets, like Bitcoin. Because Bitcoin doesn't pay interest or dividends, when the Fed cuts rates, the opportunity cost of holding it drops, which theoretically boosts its appeal. But you know, there's always a catch. In this case, it's the inflation complication. If stubborn inflation hangs around because of supply shocks or high energy prices, central banks simply can't cut rates aggressively. If they're forced to keep rates higher for longer, that essential liquidity just won't flow into risk assets. Honestly, that alone could stop this Bitcoin rally dead in its tracks. It is all tied together. Section 4. Supply caps and regulation. While macroeconomics and the Fed dictate the demand side of the equation, we can't ignore the strict rules governing Bitcoin's supply. The magic number here is 21 million. The Bitcoin protocol is structurally hard capped at a maximum supply of 21 million coins. And over time, the rate at which new Bitcoin is created declines. What this means is that any major sustained increase in institutional demand can have a drastically magnified impact on the price, simply because the supply is strictly limited. And we have to ask, who actually controls the supply that's already out there? The whales. These are the institutions, funds, and massive wallets holding huge chunks of the supply. Because most Bitcoin already exists and is held by these long-term players, their behavior is absolutely critical. If these whales decide to hold tight and refuse to sell while ETF demand is surging, available supply dries up, and it heavily amplifies price movements upward. But conversely, if they decide to cash out, a massive wave of supply can hit the market. Adding even more fuel to this institutional fire is a shifting legal landscape. Back in March 2026, the SEC issued an interpretation that finally provided some much-needed clarity, drawing better lines between digital commodities, collectibles, and securities. That kind of regulatory clarity is a massive deal. It pulls a lot of uncertainty out of the market, making it way easier for massive asset managers and banks to confidently step into the space.
Section 5. The Bull vs. Bear Case.
All right, we've gathered our structural and macroeconomic clues. Now it's time to objectively weigh the evidence on both sides. But first, we absolutely must acknowledge this enormous psychological gap, $126,000. That was Bitcoin's all-time high back in October 2025. With it currently trading around the mid-60K mark right now, we are still incredibly far from that peak. For the bulls, that gap represents a massive opportunity, but for the bears, it's proof that a true recovery is still a long way off. And hey, we also have to address the whole digital gold narrative. Supporters love to compare the two, but look at the reality. They behave very differently. Gold has thousands of years of monetary history, it's relatively stable, and central banks hold it everywhere. Bitcoin, on the other hand, was created in 2009. It's highly volatile, and it's increasingly reliant on these ETFs for institutional adoption. Investors really shouldn't assume one simply replaces the other in a safe haven portfolio. They are currently entirely different beasts. So let's synthesize the bullish evidence. The bulls will tell you we are looking at a truly unprecedented setup right now. Spot ETFs have totally expanded the institutional infrastructure. U.S. regulatory clarity is visibly improving, and we're seeing renewed massive strength in ETF inflows. Combine all of that with a structurally limited supply of 21 million coins and the potential for easier monetary policy from the Fed, and yeah, you've got the perfect environment for a major expansion phase. But hold on, we have to look at the bearish risks just as closely. The bears are quick to point out that we are still far below previous highs. Furthermore, if sticky inflation delays those Fed rate cuts, or if geopolitical conflicts push investors back into traditional cash, this whole macro setup breaks down. Add in the real threat that ETF inflows could suddenly flip to outflows, plus the high leverage we always see in crypto, and this current optimism could very easily trigger a rapid, painful correction.
Section 6. The Final Verdicts.
We've laid out the structural shifts, the macro pressures, the regulatory updates, and those psychological hurdles. So what is our actual takeaway here? The reality is, instead of throwing darts and guessing if Bitcoin is hitting $100,000 tomorrow or crashing to zero, there is really only one question we should be asking ourselves as we look at the data. Are the conditions necessary for a sustainable bull market actually developing? To answer that, these are the key indicators you need to be watching going forward. We need to see consistent multi-week ETF inflows, not just one lucky week. We need a sustained technical pattern of higher highs and higher lows to prove an actual upward trend. We need to see easing global liquidity and cooling inflation. And crucially, we need strong trading volume with Bitcoin actually leading the charge, rather than just a surge of hype around highly speculative altcoins. Bitcoin's next major move depends entirely on these structural factors.
The clues are all there, and I'll admit the bullish signals are definitely flashing right now. Institutional money is paying attention. But I want to leave you with this final thought to consider. Will sustained demand actually show up month after month to confirm a true bull market? Or is the excitement we're seeing today just another temporary high before the next macro shoe drops? Keep your eyes on the data, folks, because only the market can answer that. Thanks for joining me on this explainer, and keep learning.